Hi guys, here's Doc's Market Minute for Tuesday, April 19th. It's still a couple of hours before the market open, and so far the S&Ps are gapping higher by 11 handles, and it could be a lot more by the time that the actual cash market opens. You just never know what's going to happen with that. But I think we're starting to see what's actually happening with this market. It's starting to become very, very clear, especially in the last week or so, what's going on. Now, these are the actual S&P futures, so I wanted to, since I'm recording this after hours and we're seeing the gap higher today so far, I wanted to be able to use the S&P futures just so I can show what's happening pre-market here. So this is kind of playing out the way I sort of expected it to last week. Not only are the first quarter earnings results sort of better than expected, after all of the negative news that we had and the negative expectations that we had for earnings, this is the game that continues to be played every single quarter as everybody sandbags the results and all of a sudden surprises to the upside. And this is what occurs, is that all this negativity has got to be flushed out to the upside. The other thing that we're seeing is this global search for any kind of yield as region after region of the world goes into things like negative interest rates and quantitative easing. There is a desperate search for yield. And this is why we're seeing all this money flowing into these big, boring Dow 30 blue chip stocks that pay a dividend. I mean, it's amazing what's going on right now. So let's step back and look at the charts. Remember, what we had just 2 months ago was a nasty bear market setting up with a monthly downtrend. These almost always resolve to the downside after some form of what I felt was going to be sort of a rising wedge pattern resolving to the downside, heading down to S&P 1600. Unfortunately, I think everybody else saw the same thing happening too, and when everybody sees the same thing, the opposite usually happens. So I think what has happened here over the last year and a half or so is that the S&P, instead of correcting through price, has corrected through time after this massive move here that we've had really since the reset was in 2011, and then we've seen this thing absolutely take off, especially since 2013 when all this new policy money was instituted. So now we're just setting up a huge horizontal pattern and threatening to break out to the upside. Okay, so this could be considered to be a halfway house. What's at stake here is what I believe about 500 points on the S&P, either to the upside or the downside. But right now it's looking very strongly like the S&P wants to break out to the upside, especially with all what's going on around the world. So a couple of things here. First of all, it's not going to happen all at once. It's not going to happen all at once. I think if we do end up punching higher, these highs up here were about 2,100. Now we're still about 30 points away from punching into new highs on the cash index. This is the S&P continuous contract, and what it doesn't factor in is the cost to carry. So there is some distortion on this specific chart. If I go over to the S&P cash index, you can see that we're still somewhat below the lows here. And with today's gap up, we're going to be over 2,100 probably to open, and then be probably 35 points away from setting those all-time highs. Regardless, there's going to be a lot of short interest hanging on up here. There's going to be a lot of overhead supply from people wanting to sell into the highs and or take profits on this move up. So that can work two ways. Either that's going to provide, if the sellers outnumber the buyers at this point, then it will provide overhead resistance or overhead supply, which will be unable to punch through on the first time through there. So what we might start to see is not necessarily weakness, but this could be a place where we correct. Also, what we're also seeing here on the weekly chart, we only have a limited amount of time left before this swing is going to need to print some form of higher low. So I think this is going to manifest itself in a scary move back down, which is going to catch everybody by surprise. Remember, when everybody starts to see the same thing and head in the same direction, this is usually where the smart money will run and take the other side of the trade. and create that overhead supply. I think either that or something will happen, some kind of negative news event, which will occur to give an excuse for markets to take profits up here. So we'll pull down probably to some kind of major fib level, whether it's 23.6 or 38.2, and print that higher low. This is very necessary. Even if the markets end up going higher, it's very necessary to provide this type of print. You can see that this is happening on a fractal basis on the daily chart. Every time we reach higher like this, we're pulling back, increasing the negativity, and then that negativity is being unwound to the upside. Markets must have a certain degree of skepticism if they want to rise. They can't go forever if there's too much complacency, too much bullishness. So a healthy dose of skepticism is necessary for this to go higher. So we need to have a quick little micro shock, I think, to be able to relieve this exhaustion, because it will be exhausted by next week. By next week, we will see that. But by next week, we will also see a golden cross happening again here, which is, again, one of those rare things. Now, we had one of these back in December, cross to the upside, and then that actually got reversed right back here as we fell off the cliff in January. So that's what I'm thinking at this point, is that ultimately I think we're going to be heading higher just due to central bank policy. It's nothing to do with markets. It's nothing to do with what they should do or shouldn't do. It's nothing to do with the U.S. economy at all, and its lack of growth or GDP or anything like that. So disconnect yourself from today's reality and look at the price only and what's moving price. The price is obviously, we're in a demand and supply imbalance right now, and demand is stronger than supply. So this is why prices are moving higher, and I think it's only a matter of time before we punch into new highs. Here's what's at stake again. 500 points of energy on the S&P. I think at a minimum, this is the potential for the next big swing to come along. And lest I remind you here, every time we see a signal like this, with all this nonlinear energy like this, like this, like this, here, this is not a very frequent signal. But every time we see this amount of energy piled up on here, we usually get a significant move, whether it's to the downside or to the upside. There's no lack of movement every time we see one of these signals. So I believe that we're on the brink of seeing a huge, huge signal here coming up pretty soon. And right now, what the market's trying to tell us is it's very, very likely to spool out to the upside. So again, in summary here, so just in case you need this all put together, I think ultimately we're going to reach a little bit higher here. We're going to reach a little bit higher here until we absolutely exhaust this weekly chart. It's going to reel in every single last retail trader. Well, just about every single last one, right? It's going to pull in a lot of sideline money to the point where all of a sudden it's going to be temporarily exhausted. Some catalyst will come along and convince people to take profits. That will lead to a scary move back down. And ultimately, I think that will just print a higher low. And then what happens after that, I think, is going to be interesting, because if it goes out and punches through this prior high, then we have the uptrend confirmed and the race is on. However, we could also just as easily see this stall out, and then who knows what happens at this point. If it creates that lower high like that, just about anything could happen from there. But I think the odds right now favor the bulls to the upside just because of the policy that central banks have created around the globe. That's it for today's Market Minute. Thanks for listening, folks. We'll see you soon.